Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. Y'all know that drill. Smash that like button, subscribe if you already haven't. And just remember the disclaimer nothing should be construed as financial investment advice. These are just my opinions, thoughts on the markets. You can read more about the disclaimer below. I'm not a financial advisor. So let's get into today's stuff. Very interesting stuff. And I'm someone that really follows the markets intensely. But one of the things that's really strange is how hard it is to really follow what's going on. You hear all this stuff, and now some technicians will be like, well, you got to turn out the news. Well, fine. I mean, I guess. But, I mean, the truth is, it's very hard to even price. Things go up, down, swings. Uh, it's very hard, and this is why. Is I'm going to share my screen, and this is the 5 day right here. The S&P was down for the week, down 0.47. I read somewhere that let me just see the Dow too. That the market was down for the week, and it was just up so much. I was like, yeah, see, the Dow was down 0.16. I don't know if the NASDAQ was. I wouldn't be surprised if the NASDAQ was up. But yeah, and the NASDAQ, that 0.27, so that was down for the week. I never would have guessed. All that's going on and everything. Of course, if you're like me and work a full-time job, you would have never guessed that the market was going down. And it's not even news and stuff I've been reading. It's just based on sentiment, swings. I follow price a lot. And let's see what gold did. Let's do a 5 day. Gold was up this week. So this week, gold's outperformed stocks 3.1%. So we'll just go gold. Let's just keep going. We'll work with this. I never even thought about this. We'll do it against the S&P 500. A lot of people, some people like the Dow Gold, but to look at it on a daily basis, gold was down today. Gold was down the market was down for the week. Gold was up. So gold's outperforming the S&P for the month, 3.72. Gold's up 8.92. So gold's up 6 months. Yeah, gold's definitely out. Yeah, the S&P is down, so gold's performing out on the 6 months, year to date. Yeah, it's definitely year to date. And 1 year. So yeah, on all metrics, gold's outperforming the market. I think if I did the Dow. So gold's still in an uptrend against stocks. And I was actually reading, I was listening to this guy, JC Perez. My friend Rahul told me about him. And this guy thinks that the gold bull market's going to go to $8,000 gold or 8,500. That's going to be, and I joked, I was like, oh, God, half my holdings will be sold by then because the last 2011 top put so much scars on me. That's one reason I sold at 3,000. And I was like, okay, you have a lot of debt. Well, I didn't have a lot. I had a lot of debt from me. My credit score is 800, so I have a good. And when I had this debt, my credit score was like 775. It wasn't like anything astronomical, but I was like, well, why don't we sell, get rid of this, so that way I don't have to worry about monthly payments. I don't have to worry about this, and my wife doesn't have to, and so that really helped. And so that's one of the reasons is just regardless if the gold market tanks, at least all the debt's gone. So anyway, I think gold has one more upswing, and I think now it could be now if Jordan Royburns think about a market probably crashing in 2027 through 2029, and then gold goes up until then I think then I think gold could go to 8,000. I don't know. I'm not sure. what's going on. I think this year the stock market's gonna it's not gonna crash. Warren Buffett is I think he would have gotten out a lot quicker. Like you saw with the banking stocks, how he was selling aggressively before all those banks that went under, I think a year, not in 2024, but in 2023 when all those bank failures started occurring. So that's what I think. I think the days of investing or whatnot are over, but let me get, because I hear noise in my computer. So, first thing, want to talk about gold top stocks as the second favorite long term investment. Real estate is still number one. And this is just very short sighted. Real estate just doesn't have a long history of going up. There's the 2008, which just destroyed people's lives. And that's never talked about in the media. And up until the easy money, if you look at history back in the 60s, most people forget last week. So don't expect them to, remember history. But stocks, I mean, real estate doesn't go up all that much. So I don't look at housing as an investment. I look at your home as like that's where you live. And not only that, all the upkeep and everything else, yeah, I would definitely say. But here it is, gold surpassed stocks as the second most popular long-term investment for Americans, suggesting Americans may be altering their investment habits following a shaking period for the stock market and forecast of problems ahead for the US economy. Only 16% consider stocks as the best long-term investment group, down 6 percentage points from a year ago and falling behind buying gold, which rose 5 points to become ideal investment. So I would say this is why I think gold probably correct for some time, meaning a couple of months, because I don't like hearing that like gold's loved like this. So the upturn in U.S. investors for gold is becoming notable, but still long way behind the jump that we've already seen in Western Europe. Well, I mean, Europeans know more. Like, I mean, I'm married to them. I grew up in America. If anyone knows, it's me. Uh, like this is BS. Gold helped by Trump's Truth Social post. Well, what about 2024? There was no tariffs there. Gold was the best performing asset. And what about from 2000 to 2010? If you look at it before in 94, we had NAFTA, we had all these free trade. It was free trade galore. Like, why did gold rise? It's just nonsense. So, anyway, I looked up the commercial real estate and I don't have too much uh, for it, but this is conservative. This is just chat GTP. It says recent commercial real estate news includes a mix of market shifts, deals, and challenges. So challenges, and I've pushed my ideal back. I think commercial real estate, that bubble will burst, but I don't think it's the first one. It says the industrial sector has experienced strong demand, but office space is facing challenges and need for redevelopment in some areas. So you can still see, despite all these return to office, there's an over occupancy, and these return to work all or RTO, return to office mandates are a failure. And I'll just say this: when you're firing people and laying people off, you don't have employees to go to work, so offices aren't going to be filled up. And number two, all those shops around and food and those restaurants and stuff that people go to lunch. Well, one, people can't afford to go to lunch, so what do? Since they can't afford to go to lunch, they either bring it from home or they skip lunch, or they just like take a banana to work and that's all they need. Or if it's not lunch, if it's not lunch, they get laid off. They can't go. So I mean, when you're laying off a lot of people, they're not going to go. And with the threat of being laid off, they're not going to go out to lunch. They're going to cut every penny. So I think these challenges are still going to be faced, but I think the return to office has gave it a lifeline, but it has sped up the auto loan bubble and the credit card bubble, which I've been covering. I keep giving the news and showing that these problems are CoStar. I don't remember that company. I might sign up for their newsletter if they have a free one. Not paying them. But speaking more of the housing market, look at this. This is Money Talks. Priced out. First time home buyers are at a historic low. So right here, you can see their historic low. And that's the thing. When these boomers start dying off or needing to downsize, I haven't read somewhere boomers need to downsize, but they can. And let me see if I can find this out. Look at this. Many boomers face challenges downsizing. Rising costs. So, yeah, that's one of the reasons. And this is probably one of the reasons the boomers can't downsize. It's because there's not a lot of good jobs. A lot of the jobs in America are low paying and subpar. And because of that, they can't afford the people in the first home buyer demographic, probably anyone 45 or under, they can't buy these homes that the boomers need to sell. And eventually, if they're not going to sell, whoever inherits this home, they are going to sell. And when they sell, that's when the market crashes. But we're already seeing prices go down in certain areas. Certain areas don't have it, and you see it here. Massive price cuts hit the U.S. housing market. So high mortgage rates, rising inventory, and waning demand push sellers to slash asking price. So here are the cities: Phoenix, Northport, Tampa, Cape Coral. Denver, Colorado is the only non-Sunbelt city. So Florida and Texas, they're having their problems, but it's not just, oh my gosh, McDonald's under 21. But the thing is, it's not contained to the Sunbelt. It's going, it's going to go national. It's like the domino, like the first place in the housing market, I believe, was Florida. But here's more, and this is why the office building bust is inevitable and everything else. Panasonic, they're cutting 10,000 jobs. And look at this, not till the fiscal year 2026. All right, get rid of that. So, and that's what the thing is. A lot of these layoffs we read about, they're not going to show up in the data till next year or and some of these not even the year after. So, and this is what I wanted this I just thought was interesting. And I talked about this. U.S. job market actually lost jobs in quarter three 2024. BLS reported 1,000 job losses after 163. This is contrast to the estimate showing 399,000. And so it says it right here. Like if you look at it right here, here's the chart. June 2024, that's negative. September, and this is the thing, and this is what they're doing. New boss, same as the old boss, but more downward vision revisions are expected to come. And that's what they're doing. They're just having a big headline number so it doesn't hurt the markets. And what they're doing is they're revising these downward. And I think this is why I always say, there's going to be a stimulus. Trump, he's caving on trade now. He does not. He's a weak man. He is not willing to take a stock market hit. Now, a stock market crash probably will, or a sizable decline, is going to come during his presidency. It won't be like the last one. But yeah, he's caving already. And the next cave will be Jerome Powell in the Fed. He's going to go and he's going to lower rates. And this is interesting. JP Morgan loves gold. And I always say my next target's $50 silver. And then that's when I'll probably sell some things. But JP Morgan, this isn't Kitco. Gold could hit 4,000 by next summer, even in a positive global growth scenario. So you hear about this. I don't really like when you hear headlines like this. That sometimes that is a potential topping, but as you can see, JP Morgan, they love gold and they're really big on they're 4,500. That's a big move. That's another from where it is now 1,200. So what I want to show up is one thing I'm doing with my daughter. It's just a strategy and just want to share it from you. I learned this from Jim Paplava, Financial Sense News Hour. And it's something that I want to do with a young kid because by the time my kid's 30 or 40, I'll probably be long gone. I don't mean that in any sort of sad or whatnot way, but I had my kids late. Well, my next kid, whenever that is, having that late. And so one thing I'm trying to do for it is dividend income. So it has income and it has passive income by the time it gets to 30 and 40. And how I learned this on Financial Sense News Hour and Jim Paplava. And the reason I waited till the end is very few probably watch it all the way through. So I only want the loyal listeners to learn this strategy. And this is instead of trying to accumulate price appreciation, what you're trying to do is you're trying to accumulate shares. New N0 period apostrophe S numbers of shares, and that's your goal. And so like what I do, I'll share my screen, is I'll look at companies. I buy only boring stocks, so it'll be like Clorox. Like this is something Clorox. I don't know how to spell it. Do you know how to buy it though? So it's like right now, I wouldn't buy this mainly because I think the stock market's expensive. But what isn't expensive right now that pays good dividends and has everything? But general stocks, I would look at like McDonald's, Coca-Cola, Clorox. They call them for forever stocks. Stuff you need: Johnson and Johnson, Procter and Gamble. Not these are not a buy and sell to recommend. But what I'm buying right now is I'm trying to look at what's cheap. The Dow stocks, those are not cheap. Gold, it's not cheap. So I'm not going to buy any royalty and streaming companies, which I think they'll pay big dividends. There's not really many dividends in the gold sector, but for this strategy, I'd only consider the royalty and streaming because they're really long life mines, steady, predictable cash flows. And just, I think they'll pay dividends over time. But what is emerging markets, I guess you can say, is what is this? Forget what market this is. But what is cheap right now? And this is the stuff I'm not investment advice, just my opinions and thoughts. But what I am buying for my daughter right now, and I just want to share this. Where, like, is there really any gold? You can tell oil is super hated because you just, oh, there it is, commodities. What is cheap is crude. And not that, the Brent and the WTI, West Texas Intermediate, and Brent. But if you just look at oil on a 1 year basis, let's do it how I do it before. On a 1 day basis, it's up 1.15. 5 day basis, up 4.75. On 1 month basis, though, it's down to 2%. 6 months, it's down 13. Year to date, it's down 13. 1 year, it's down 22. Now, 5 years, it's up, but on 1 year, it's down 22%. This is astronomically. And if you look at it, this is the high rate. No, 08's the high. 2022 high is 105. Now it's at 60. It's really low. So, what I would look for is now this is a company I like, and this is full disclosure. My daughter owns it. She's like a month old, so she doesn't even know she owns it. So, not a buy or sell recommendation, but I'm just showing you my strategy. So, right now, I'm not, there is some sort of banking crisis or whatnot, but she's young enough she can hold on to her shares, get them back. You do get your positions back. Not a financial advisor, investment advice, just what I know. So, what I look is, first of all, just a general look at statistics. One thing I love about Yahoo Finance, they have them all. I can do them on, but sometimes I have so much to do. So if you look at it, enterprise value, which if you don't know what that is, I'll just show it real quick. Enterprise value formula. It's market cap plus total debt minus cash equivalents. That's the formula. And basically, the reason why they have debt is you absorb it when you buy it. But when you buy a company, it's a cash rebate. So, and then market cap is this is number of shares outstanding times the actual price of the shares. So, if you look at it, enterprise value to EBITDA, that's 3.91. It's trading out less than its revenue, not even one. It's trading basically price to book. This isn't exactly a PE. I don't really like for resource investing, but and then obviously you can tell it's profitable. It says that's the profit margins. This is the operating profits from operations, return on assets, return on equity. You'd have to compare it with its peers. But so they are, the equity is going, so it's not. Now you can see revenue growth, but the oil prices tank. So, and there's a lot. And I also look at the company, their plans, their productions, life of mines, how much. Look at this total cash per share, $13, 13.26.39, 52. So it's like 5 or 6 times cash, which is a good deal. Current ratio, so book value per share. So this is trading almost at its book value. And you can tell, look at this. Free cash flow, 14 billion. So it has free cash flow. Payout ratio is a little high, 56%. So that's based on retained earnings, but forward annual yield, 3.87%. So anyway, and so what I do is just keep holding in source. This doesn't have, but Total is so big. This is like basically the biggest company in Europe. So anyway, valuations are very low. Financially sound company and high barrier to entry. A lot of capital is needed in this steady, reliable dividend. So right now, if the stock market crashed, I go into stuff like McDonald's, Clorox, other things, but that is Diego PLC. Like this is another company I would love to buy. Has spirits, Johnnie Walker, Guinness, but right now, I do intermarket analysis. Now it's a British, so it's European, but right now the US stock market's high. And you can saw from my last video, the Warsaw stock market's at all-time highs. So I don't like buying them. So that's my strategy I use. Not investment advice. Not investment advice at all. Do not, do not copy me. I'm not a financial advisor. This is just my opinions and thoughts. And what I'm hoping is when my daughter's 30 or 40, she has a stream. I would love it if she can live off the dividends, but she has some stream of income or at least a second income to go with her job. So anyway, hit that like button, subscribe, and just remember the financial disclaimers below. But I wanted to share that strategy with you. Do more videos again. Do one Sunday. All right. See you next video.